and help put it together so we can get all the great investors into the room to share ideas and create a space for everyone to network. And so, without further ado, I will let Jacob take the stage. But thanks for coming out. We will try to minimize noise from over there, but it might get kind of noisy. If you can't hear,
just raise your hand. Yeah,
just raise your hand if you can't
hear.
It can be kind of tough.
And I'll speak directly to you.
Yeah,
that'd be great.
And we'll try to get some more chairs in here too. I'll look around. Anyways, thanks for coming out.
Thanks, Jordan. Hey guys, thanks for coming. Many of you probably first time. Some people have been here before. We just put on this meetup just to help everybody learn how to invest in real estate, become a little bit better. Lots of things to know about real estate, lots of directions to take it. There's no one way. So whenever you hear, hey, this is a way that it can be done, just understand there's a lot of ways to do this. So, quick introduction. I have been investing in real estate for probably about a decade now. I grew up around it. My dad taught me a little bit about it. I didn't really start pursuing it professionally until about 3 years ago. In the course of those events, I was a real estate agent, did a lot of transactions, learned a lot, and then met a couple of really cool guys, Luke and Michael back there, if you guys want to raise your hands. You'll see them at the end. So they were clients of mine, but they had some really cool stuff going on, so we ended up starting a company called Renjoy. Renjoy does investment brokerage, but we also do short-term rental property management. So that's Renjoy. Today we're actually not going to really talk about anything Renjoy related. We're going to talk about how to acquire real estate 9 different ways. There are lots of other ways. Obviously, if you have just cash, I didn't put that on there because I'm assuming if you're in this room, you're not buying real estate with just cash. So we'll go through those 9 ways. If you guys have questions, we'll have a Q&A at the end. If something comes to mind while we're talking, feel free to just raise your hand and I'll just call you out and we'll talk about whatever you have on your mind. Okay, so we're going to talk about creative financing. First things first though, we need to talk about terms and lingo. A lot of people in here, first time buyers, second time investors, there's some language around this that I want you all to know. By the end of this evening, you should be able to go into a meeting with a banker, a lender, and your friend and be able to explain or at least understand what the hell they're talking about, right? You don't want to be uneducated, you don't want to know the terms. So we're going to talk about those first, and then we're going to go into the 9 creative ways to buy real estate. So first, we're going to talk about capital stack. Capital stack is just what's the equity value of my piece of real estate. Can be 3 components, there can be more than this, to be clear, but these are kind of 3 of the most common components of a capital stack. You have your first lien position, this is your first loan. You have a second lien position, potentially, this is your second loan. And then you have your equity, this is what you own, this is what you would count towards your net worth. If you were to sell the property, you have to pay off first lien first, second lien second, and then equity holder gets their funds last. Okay, so this is a capital stack. Now you know something that you may not have known before. Okay, liens. Liens, pretty simple. It's basically a claim against an asset that you own. So it's debt, a loan, secured against an asset, something that you own. So a lien, when we say first lien, there's a loan, a promissory note underneath this that is collateralized by your piece of real estate, by your asset. It doesn't have to be real estate, it can be all kinds of stuff. So that's what a lien is. It protects the debt holder. You can't sell this asset without paying them back first. That's why it's called a first lien, right? So when you sell this property, let's say you don't sell it for market value, let's say you sell it for less than market value, well, first lien gets paid first. Imagine that, okay? And then second lien gets paid second, and then the equity holder gets paid last, okay? So that's a lien. Debt, everybody knows what debt is, you owe somebody money. Okay. Equity is your value, your ownership of whatever is left over. Right here, this is the top of the capital stack, that's equity. It's what you're worth. Origination, this is typically a fee that's charged when a loan gets created. So when you choose to go borrow money, somebody's doing work to create that loan. That's called origination. That's work that they get paid for through what are called points. Points are a percentage of the value of the loan. So if you borrow $100,000, it's a $100,000 loan. 1 point on a $100,000 loan is $1,000. Okay? 1%. So when an originator gets paid by points on the loan, that's what we're talking about. It's a percentage of the loan that they're originating. Okay? Any questions on those terms? Cool. All right, moving on. Number 1, traditional mortgage. We're not going to spend a lot of time here because most people here probably know how a traditional mortgage works. You typically do 10% plus. A lot of people will put 20% down on their mortgage. Lenders, the person actually giving you the money, sometimes will hold that promissory note, which is in that first lien position. Okay? These are like banks, credit unions, mortgage brokers. You can get a traditional mortgage loan in a lot of places. This is what almost everybody thinks about when they're buying a house. Okay? So I'm going to give you a quick example on a normal mortgage on a property that I purchased. So on this property, I put 10% down, I borrowed 90% loan to value on a 30-year fixed rate loan with a 30-year amortization. Does anybody know what an amortization means? Where we get on with that? Okay, great. Amortization is just the period over which you're paying back the loan. There's more to it than that, which we're not going to get into, but we can talk more about that later. And then the interest rate. So that's just a normal house, bought it, normal mortgage, lived in it, did the normal real estate thing, right? That's how a lot of us start. Some of us start. Second way you can buy real estate is through Fannie and Freddie loans. Again, another common way to buy real estate that a lot of people do. Who here actually has a Fannie Freddie loan? I'd be curious. A Fannie Freddie Mac loan? Who here has one on a piece of real estate that they own? So there's a handful of people? It's actually less than I was expecting. Okay, so Fannie Freddie loans, very common. Fannie and Freddie are government, quasi-government organizations that basically subsidize your ability to borrow money to buy real estate. It's the simplest way I can explain it. One of the big ways that they do it is they allow you to put less money down to buy a piece of real estate. So the Fannie Freddie loan, you can buy a piece of real estate with only 3.5% down. The reason why that matters is because it means you don't have to have a bunch of cash to buy real estate. A lot of people don't realize this. You can buy real estate with less than $10,000. It can be done. Lenders, people who originate these loans, almost never hold on to the loan. They typically sell it out. Somebody else will buy the loan from the lender, and then it'll be serviced by a whole other company. So typically when you're making your mortgage payment, it's not to the person who helped you get the loan. Again, you'll go through banks, credit unions, mortgage brokers. A lot of people will do Fannie Freddie loans. They'll originate them. One important thing to keep in mind with these loans is you have what's called PMI. Everybody know what this stands for?
Primary mortgage.
Beautiful. Okay, we're moving on. I'm not even going to bother. If you don't know what that means, just let me know. Here's another property that I purchased, a condo. I used a Fannie Freddie loan in my first position. I did do 10% down because there was a unique program that a local credit union was offering where they said, hey, if you buy a property in our county, we will cover your down payment. And I was like, sweet. So I got a first position loan, 10% down. 10% down, but my 10% actually became the second loan, which I'll explain in a second. So I bought this property, put 10% down, 30-year fixed, 30-year amortized, 3.1. And then I went to the credit union and said, hey, credit union, you told me you were going to give me 10% if I bought this property. So the credit union said, yep, you're right, so we'll give you 10%. So then I didn't put any money down, and I bought this condo with a second loan. So this is in second position. Everybody remember that capital stack? First position, second position, equity? Okay. So when I bought this property, how much equity did I have? Zero. That's right. I didn't have any equity. If I sold that property, I wasn't going to get any money. Okay, so second position loan, but I acquired an asset that made me $200, $300, $400 a month, and it cost me nothing. I didn't put any cash down. So that's a second position loan, which we're going to get to in a second. So a third way you can acquire real estate is through commercial lending. You can use commercial lending for residential properties, unlike people don't realize this, but you can use a commercial loan to buy residential real estate. Obviously you'll use it for a lot of other things, but it is a way to buy residential real estate. Typically, you don't buy residential real estate with a commercial loan because Fannie and Freddie make it cheaper for you to buy a loan. They're subsidizing your costs. So you typically won't use this until you get further down your investment journey. But there are some big pros. You have a flexible structure. The way the loan works, the way you secure it, the way you buy the property, the way you pay them back, all of that is super flexible and even negotiable. Fannie, Freddie, federal government, who knows the federal government as being a flexible negotiator? Anybody? Yeah, they don't. They play by the rules, you follow the rules, that's the way it goes. With commercial financing, you can actually modify to your heart's content. There's a lot of things you can do. typically whoever originates the loan, remember the originator is the one who creates the loan, they're actually going to hold the promissory note that is secured against your property. The reason why that matters is because if your lender is somebody you know personally, and you're having an issue for whatever reason, say a pipe burst, you didn't have any people in your property for a month, what have you, if you know them personally, they'll work with you because the lender also holds your note. So they're not going to say, hey, Jacob, you didn't pay your mortgage. I'm going to come after your property. They're not going to do that because you can say, well, hey, Frank, I understand, but like, here's what happened. You guys hold the note, you understand, just tack it on to the back, or I'll pay a one-time fee or whatever. They'll be flexible and they'll work with you. Huge advantage of a bank, okay, with commercial lending.
Question.
Yeah?
Well, why are they willing to do that?
Because they don't want to take your property. Why don't they want to take your property?
Then they have to figure it out.
Well, who said the loan business? Yes, that's right. They're in the loan business. What does that mean they're not in?
They're not in property management.
Or managing real estate. That's right. They're in the lending business. They want you to keep managing the property. They don't want to take it. Okay? So they're not going to foreclose on you. Well, if you don't pay them over time, they will foreclose, of course. They're not stupid. But they don't want to take over your property. They really don't. They'll work with you in a lot of crazy ways. Especially over COVID, we saw some crazy debt restructuring that's like unheard of. Okay? But this personal relationship will go a really long way. Okay, the fixed period of your interest payment is much shorter. This is actually a con, not a pro. But generally speaking, your loan is only fixed for a certain period of time. Right? So if you think about like an ARM, anybody know what an ARM is?
Adjustable rate mortgage.
What does that mean?
It means that your interest rate has the ability to go up.
That's right. That's right. Your interest rate can go up or down depending on the market. With commercial debt, typically you're fixed for a much shorter period of time. With a residential loan, another way that they're subsidized is you can get a 30-year fixed loan that's unchanging. So even over that 30 years, mortgage rate stays the same the entire time. Do you have a question?
I'm going to ask a lot of questions, so if I'm asking too many,
No, you're good.
cut me off. But who's eligible?
Who's eligible for this loan? Everybody's eligible for this loan.
Yeah. Is
Yeah.
it just based on how well you smile, or like?
That's right. That's right. It's about how charming you are and how many beers you get them to drink. That's what it's about. No, that's not true. Basically, a commercial lender, all they're going to do is they're going to look at your tax returns. That's all they care about. They're not going to look at, like, they may look at your W-2, but they don't really care about that. They're only going to look at your tax returns. They're going to look at your credit score. That's about it. So it's pretty easy to get a loan if you've got a good tax return. Okay, it's a great way to scale. You can buy really big properties with these loans, right? Typically when we buy a house, we can only get, maybe $750,000 to borrow. With a commercial loan, I mean, 75 million, 100 million plus, okay? You can get plenty of cash this way. One thing that they do require that's different than a residential loan is they require a higher down payment. This is generally true. Bankers are conservative, and so they will require you to have more equity. If we go back to that capital stack, they want more equity on the value of the property because it protects them from losing money, right? If you have to sell at less than what you paid for, they want you to lose the money, not them, okay? So they're going to require a higher down payment, generally speaking. It will vary. This isn't precise. Every project's different. Every type of asset is different. Okay, so we're going to talk about another project that I bought, actually with Luke and Michael. So this is a commercial property. It's a 5-unit residential property. We bought it actually with no money down, which some people would find shocking. But we bought with a commercial loan, 75% loan to value. You know how I said 25% down. 10-year fix, 25-year amortization at 4 1/10. And then we went out and got another kind of loan, which we're going to talk about here in a second, called a bridge loan. Bridge loan is just temporary debt. It's the simplest way to explain it. It's temporary debt. The bridge loan is in second position. They're on top. They gave us 15% loan to value, 2-year fixed interest only payments at 10%. This is expensive, right? You don't want to hold that forever. Very, very expensive. Also, if you don't pay them back with what's called a balloon payment at the end of 2 years, you got to give them all their money back. If you don't, they can foreclose. Okay? No good. That's not good. So when we bought this property, we put no money down. 100%, right? Or sorry, this is supposed to be 25%. So that's a typo, my bad. 25%. Everybody's like, he can do math, right? What's he doing? This is 25%. So when we bought the property, no money down, we then put in quite a bit of cash. So in order to convince the bank and convince this bridge lender, we didn't come to them with a smile and say, hey, here's some beers, great, now give us your money. We didn't do that, okay? We said, hey, here's our plan. We think this property's undervalued, here's why. We have experience operating properties that we're gonna fix this into. We're gonna bring in our own cash to renovate this property to a great deal. And on the back end, this thing's gonna cash flow, it's gonna be awesome. Here's all of our experience, all of that. And in that way, we did persuade them, which is very different than like a Fannie Freddie guideline. You're not persuading some federal bureaucrat, right? None of them care. They don't care how many deals you've done, they don't care about any of that. A banker will. They'll listen to you. They'll look at your track record and say, oh yeah, you've done this before? Cool. Yeah, we'll give you money. So we bought this property, no money down. Yeah, go ahead.
What kind of, when you came in to do that, were you using like a pitch deck, or what kind of documents did you have with you to present?
That's a good question. It was an email. Yeah. Yeah. Like, this is like a little business secret, just like about the world. Brevity is key. Be as short as possible. Punctuation is optional. Just get to the frickin' point, okay? When you're shooting an email, email the guy, say, hey, we can give you a good loan, we're gonna pay you back, we have a lot of experience, here's the deal. Boom, 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 bullets, details. Are you interested in lending? They're like, yeah, let's talk. That's it. No pitch deck, none of that. This is way fancier than anything I've ever used to get a loan.
You getting these two loans simultaneously,
Yes.
or you got to get the first and then?
No, they both know what I'm doing. Yeah, yep. Because they're both going to be on the settlement statement at closing. They're all, everybody knows what's happening.
So you're not getting through the first and then doing the second?
No, you could though.
Same.
You could.
You're dealing with
You could close if you had the cash. You could close and then go out and try to get a bridge loan. That would be more difficult, actually.
Yeah, and more expensive.
Yeah.
Double
So you have a double close. It's like these guys would be afraid you're going to take their money and run away. Like, there's a lot. It would be harder to not put it on a single transaction and a single settlement statement.
Yeah.
The other thing that was required for this deal is a good question. Yeah, I had an email, but in order to actually close, they did say, hey, you're telling us about your business plan. That's cool. Show me the money. So they wanted to see our cash in the bank account for the renovations we were going to do. They said, until we see that you've got 200 grand in the bank, we're not going to lend you money. So that was a huge contingency that was required.
Did you actually have this money?
Yeah. Yeah. No, I'm not. How else would I renovate the property? I do need
I'm
cash.
just curious if there was like another creative.
You probably could. You could use credit cards. You could use a personal loan. You could do other things. So I could have gone out and got a personal loan, thrown that into a bank account, and said, "Yep, here's my cash."
So do you have to let it season? Was that
You
a-
don't.
you
No, a
don't?
commercial lender won't require you to season. Does everybody know what seasoning is, real quick?
How long does money actually sits in a bank account?
That's right. Yeah. Typically, when you have money that you're getting from another source, and you don't really want other people to know where that money's coming from, you have to have more than 2 bank statements from when you receive that money in order for that cash to be seasoned. In other words, they're not going to ask you where you got that $100,000 deposit from Uncle Rick. Okay? All right, and so then we bought this property, no money down, put 200 grand into it. This project is actually currently in position, we haven't refinanced yet, but basically at the end of it, you create value and you refinance and you pay off your bridge. Right? When you refi, you pay this guy off. And then you take your cash if you've got cash left over. Okay, number 4, bridge loans. We kind of talked about bridge loans real quick. Also very flexible structure. Lender's going to hold the note. When they lend you the money, they're going to hold on to it. They're always, almost always, in second position or even third position. Remember going back to that capital stack? You got first, you got second, you got equity. You can have third and fourth and fifth. And the bigger your deals get, the more likely you're going to have different layers of debt. There's another word for this. Does anybody know what the other technical definition of bridge loans is?
Construction loan.
What was that?
Construction loan?
Construction loan, it can be. Hard money, could be. It's called mezzanine debt.
Now you're talking stocks.
Well, no, I mean you can have mezzanine debt in stocks, but this can also be referred to as mezzanine debt. Mezzanine debt is basically somebody who's giving you a temporary loan on real estate that's not in first position. So they don't have a mortgage necessarily. Okay, so bridge loans can be a good source of cash for renovations because you can use bridge loans. Remember in that example I just gave? We used it to acquire the real estate with no money down. What we could have done is we could have bought the real estate. We could have used our 200 grand as the down payment and then gotten a bridge loan. Why would a lender not want to do that though?
They're not on the title, they're on the loan.
It flips the capital stack. So if we close, you got your first position, and then we've got equity because we bought the property, and now the renovation loan on top of that, renovation loan can be unsecured. It can be. Sometimes they will still secure with a deed of trust, but sometimes they don't. And then they're unsecured, which makes it a high-risk loan, which does what to your cost? That's right. Higher risk, higher cost. Okay? But it can be a great source of cash for renovations. Temporary loan. Any questions on bridge loans? Alright, cool. You can do this on houses too, by the way. You'll sound really smart if you say, hey, you're going to give me money for a bridge loan on my residential fix and flip? They'll be like, what are you talking about? But you sound really smart. Okay, another way you can use debt to buy real estate is called a portfolio loan. Portfolio loan is a loan for your portfolio. In other words, you have a single loan that is secured across all of your assets. You got a portfolio, you own lots of real estate, supposedly. Portfolio loan, what they do is they have one loan that underlies all of your assets, and they've got a bunch of deeds of trust securing their loan against your portfolio. This can be a really useful tool when you get larger and trying to scale and trying to access equity in a really simplistic way. Right? So think about it. If you own 100 houses, or I guess in this example you own 5 houses, let's say each of these is 10. You own 50 houses. How many people want to go through 50 refinances all at once? Who wants to do that? Nobody wants to do that. You don't have time for that. That'd be crazy. So you use a portfolio loan. You do one refinance, they do one due diligence, and you get access to your equity, to your cash. Typically, portfolio loans are used for refinances. They're typically not used for acquisitions. Okay?
Can your portfolio partly be LLC and partly under your name, or does it all have to be?
It depends. It depends on the banker, your relationship with them, what they'll require. But usually, they don't care. And here's why they don't care. If it's in an LLC, your personal name, whatever, they're still going to make you sign what's called a personal guarantee. Anybody know what that is? A personal guarantee. Go ahead.
Meaning that if you default on the loan, rather than the LLC being responsible, you as an individual are responsible.
That's right. So they don't care whether you hold it with an LLC, a C Corp, an S Corp. They don't care about any of that because they say, Lindsay, you're going to pay me back. I don't care about any of that nonsense. If you don't pay, if these things don't pay me, I don't care. If you don't pay me, I'm coming after you. I'm taking everything you've got. So that's a personal guarantee. Typically, when you go into commercial lending, they're going to make you almost always sign personal guarantees. That scares a lot of people off. Shouldn't scare you off because you're going to pay them back, right? Some people get freaked out about that. There are some techniques called like a burn-off that you can kind of employ on some of your loans to get that personal guarantee burned off, but we're not going to get into that. Okay. Typically, you have to have at least 25% equity. Usually, it's actually going to be higher than this. So they'll only lend 65%, 70% loan to value of your entire portfolio. They want more cushion again, right? So commercial lenders, bankers are very conservative. Lenders always hold this note. They're not selling a portfolio loan on the secondary market, okay? Oh, there's a big pup. Cute. Typically, it's going to be a bank, though some credit unions will also do this. They'll also do portfolio loans. Single loan, multiple properties. It can be in second position, though that is very rare. Okay? So you can potentially have a portfolio of a bunch of different little loans, and you can get a portfolio lender to be in second position on all of your loans to access your middle layer of equity. Remember going back to our capital stack. Imagine you've got 5 houses, right? They all have different capital stacks because you bought them over different periods of time. You've been paying down your debt at different rates in different ways. They would all come in at that second layer, second position, and they'd give you one loan for second position on your entire portfolio. There are lenders who do that, though it is rare. Okay, number 6, hard money. Lots of people have probably heard of hard money. It's a semi-regulated or fairly regulated lender, similar to like a Fannie Freddie or a conventional mortgage. It's fairly regulated. Hard money has a lot of benefits, it has lots of cons. Benefits, flexible structure. Basically, you can negotiate whatever you want with a hard money lender. They can make it happen with some restrictions on it. The lenders almost always hold the note. It's typically being lent by individuals, small companies, funds. There are some big companies that do it as well. They have higher interest rates, short repayment terms, 6 months, 12 months. Usually or rarely they'll go over 12 months. Typically it's less than 12 months that you have to pay them back. And they will or can finance rehab costs. Something that's really important to note about hard money, they will benefit or they will provide much better terms for somebody who's experienced or is introduced by somebody who's experienced, who's vouching for that individual. The reason I'm telling you this is because you want somebody to introduce you to a hard money lender. You do not want to just go out and find whatever hard money lender that's out there. If you do, they're going to charge you 14, 15% and 2 points of origination. If you get introduced by somebody who's been successful, borrowed the money, paid them back, borrowed the money, paid them back, they're going to give you much better terms. Okay? Yeah.
What could your hard money lender give us?
Well, to be clear, you have to get somebody who's willing to vouch for you. I'd vouch for you, Lindsay. But I wouldn't vouch for anybody in this room, right? I don't know most of these people. But 10 and 1. Yeah, 10 and 1. Hard to get 10 and 1 today. You can do it, but if you're experienced.
What's that mean?
10% interest, 1 point origination. So if I borrow $200,000 from a hard money lender, I'm paying whatever that is, $20,000 a year, a little bit less than $2,000 a month, and I'm paying what, $4,000 or $2,000 in fees. Okay. Typically, hard money is used for a temporary use of cash, just like a bridge loan. Remember we were talking about the bridge loan? At the end of that, you refinance, you pay them off. You got what's called a balloon payment. At the end of hard money, you also have a balloon payment. This should be a temporary use of cash. You should really be confident in what you're doing before you borrow these guys, because they'll take your shirt. But they also will make it easy for you. You can get cash in 3 days. I mean, you can go really fast with these guys. Okay, any other questions on hard money? Typically used for fix and flips? Cool, okay. Oh wait, sorry, I was going to give an example. Here's a house that I flipped. Borrowed money, they were in first position. I did have to put 10% down, so they only gave me 90% loan to value of the purchase price. Sometimes they'll do some funky math with like ARV. They'll give you a percentage of your after repair value. I typically don't even bother with that. I just say, all right, give me 90%. 6 months, I had to pay them back. 6 months. I only got 6 months. Okay, 10%, 1 point origination. They can fund the reno. I haven't done this, but they can fund the renovation costs up to 100%. So one of the cool things about hard money is you don't need very much money at all to do a deal. So I bought this at $390K. So all I needed was $39,000, right? 10% down, I didn't need any of my reno number. They would have paid for all of my construction costs. And then when I sell, pay them back. Okay? If you're not experienced, 6 months is fast. For a lot of people don't realize that. Days on market today, 30 plus, or what is the average? You know, Jordan's like 24?
43.
43? Wow, I don't know anything. Okay, 43 days on market. That's a month and a half of just being on market. That assumes you finish. Then on top of that, you've got 30 to 45 days to close. All of a sudden, guess how many months this is to do your reno? Less than 3. You've got less than 3 months to complete your renovation. For a lot of people, that's really fast. Okay? We have a guy who's going to come in and talk in February. George, if he hasn't left yet, did he leave? He left. Okay, he left. He'll do it in 90 days. Close to close. And he'll explain how. Okay, number 7, private money. Yeah, you like this? This is pretty great. Typically, this is where private money comes from. Yeah, private money comes from friends and family, typically family. They are oftentimes less motivated in taking your shirt and more motivated in helping you out. So, a lot of times the terms are going to be more friendly, they're going to be more flexible, there's a lot of huge benefits to private money, it's just hard to get. Okay? It's not like anybody's just going to give you a bunch of money. Flexible structure, they hold a note, obviously it's a promissory note. If they even make you sign one at all, lots of private money people will just give you money and they won't have any agreements or anything, it's crazy. They're typically known by the borrower, most often family friends, and is obviously the best source of cash. You cannot beat it. So before you start going around talking to hard money lenders, talking to the, like your neighbor next door, talking to a banker, any of that, talk to your family and friends first. They will help you out. Now, I'll add a word of warning to this. Do not post on social media, say, hey, give me money, I'll make you money back. Don't do that. That's bad. Don't do that. Do you have a question? No. Oh. Don't post publicly asking people for money. That is not what I am saying. Okay? Don't publicly ask people for money. You can privately ask people for money. Okay? Cool. Any questions on private money? Typically, by the way, when you're going to somebody, make them an offer. They're not going to come to you, right? They're not emailing you and saying, hey, borrow money, borrow money, borrow money. You're going to go to them and you say, hey, I've got this idea. Here's my plan. In an email, I guess you could do a pitch deck, but I wouldn't do that. I'd send them an email or a phone call. Like, hey, I'm thinking about this thing. I'm confident I can do it for X, Y, and Z reasons. Would you be willing to lend me money? Here's how I'll pay you back. Here's how you'll be protected. Here's how I'll make sure that you don't lose your money, because you need it too. Okay?
Can I add to that?
Yeah.
Don't forget that people with IRAs can use their IRA to invest money too.
It's true.
Self-directed IRAs, so those are also options.
It's true. I personally would not take somebody's IRA money, but you can if you want to. Number 8, seller financing. Okay, this is also very common, very well known. Seller financing is where the owner of the property sells it to you, but lends you the money to buy it. That makes sense? Basically, instead of them receiving a bunch of cash from you at closing, they say, you don't have to give me a bunch of cash at closing, just give me a little down payment. And instead of you giving me the rest of my purchase price in cash, let's make a promissory note. And you're going to pay me month to month, just like you would pay the bank or the lender. Okay? Seller financing can be very good. Okay? Because oftentimes when you own that property and you've got that promissory note that you're paying somebody back, it doesn't show up on your record. So let's say you buy a property with seller financing and then you go to Fannie Freddie and you want to buy a property. It's not going to show up. They're not going to see that you own this property. They're not going to worry about it. They're not going to ding you about it. None of that's going to happen. Right? So you can buy a bunch of these things. Fannie Freddie will never go away. You'll still be able to borrow with that federally subsidized loan even after you buy real estate with this. Okay? Again, it's pretty flexible. Oftentimes a seller is going to propose terms to you when you go to them. Often you'll say, hey, will you consider seller financing? And they'll say, yes, at these terms. Sometimes they'll say, yes, tell me what you're thinking. That is a great opportunity to pitch them on some kind of deal that will work well for you. Typically, as little cash down as possible is what we're going for. However, savvy sellers, because they've owned this real estate for a long time, they even know that they should do seller financing because they avoid tax liability by doing that. They're typically going to require at least 10% down because they know that you're a risk. Right? They don't want to take their property back, though they're different than a bank in that they will. Right? Because they know how to operate a property. They're less concerned about foreclosing on you. They're not going to be nearly as forgiving in general as a banker will be, because the banker doesn't want it. The seller who gave you the property probably doesn't want it, but they do know how to run it, and so they will take it back. So it can be a great source of buying property.
Another question.
Yeah.
What are some good things to say if the seller's never heard of it?
Has never heard of seller financing? Typically, the way I would start that conversation is trying to understand what they need or what they want. What are your goals? Why are you selling this property? What are you trying to do? And then I go from whatever it is that they're trying to do and then spin it into well, we can achieve that by doing this thing. Does that make sense?
You also need a really good attorney to kind of navigate that kind of stuff?
No, not necessarily. So Colorado has a standard promissory note as well as a standard deed of trust that you can just download from the internet.
ChatGPT.
Yeah, ChatGPT, perfect. Write me up a deed of trust, perfect. Yeah, I wouldn't do that. I would use the Colorado standard one. But yeah, this is pretty easy to do. Yep.
Hey Jacob.
Yeah.
Just one comment I wanted to make. People see this as all or nothing. Seller financing can be a portion of a loan. So you could have a seller take second position on a loan. So in the same way that we've talked about these other financing strategies, you can mix and match. You can get a traditional loan, a Fannie Freddie Mac loan, and then you can put your seller in second position.
Jordan, have you done that before?
How do you know that?
Yes, I've done this before.
Why don't you tell everybody what you did?
I found an off-market deal and I asked the seller if he would finance any portion of it because it was over the conforming limit, and he was willing.
Wait, what's a conforming limit?
when you buy a Fannie Mae, Freddie Mac, when you buy, I believe a Fannie Mae or Freddie Mac loan, there's a limit to the price of the property that you can purchase. It's based off of your county that you're in, so El Paso County for here. This property happened to be over the conforming limit of last year. It would now be in the conforming limit of this year. But regardless, I didn't want to fund all that money out of my pocket to buy down to the conforming limit, and so I asked the seller if he'd be willing to do that for me under seller financing terms.
How much did he lend you as a percentage of the purchase price?
About 10%.
So explain the capital stack to us.
I put 5% down, he put 10% down, the lender funded 85%.
Cool. You see how he bought a property with 5% down? Pretty cool.
Jumbo.
Yes?
What are the benefits of here on the seller end?
There are a few benefits. Typically, one thing that's really important to keep in mind that everybody has a very different tax situation for a lot of reasons. Everybody's tax liability from year to year will change based off of a lot of different activities. So the reason why a seller may choose not to sell their property and collect all that cash is because they'll have a massive capital gains amount of cash for that year, which could compound with maybe other things that they've sold. Right? So if they have a year where they have a bunch of capital gains tax, they'll have to pay a huge chunk to the federal government. So instead of selling the property and receiving a huge amount of cash, by originating a promissory note, they're only paying tax on the interest from that loan, not the whole balance amount. They can, this is important to actually note about seller financing, which would apply to Jordan too. When a seller finances a property, they have what's called a promissory note. Typically a promissory note is secured through a lien. Remember we talked about how a lien secures the loan against the collateral? That promissory note can be sold. Okay, so the seller who sold you this property doesn't have to hold on to that promissory note. They can sell it to somebody else. So to your point, they may not want a big capital gains tax hit when they sell the property. They think it's a good time to sell. I want to sell the property. They create that promissory note, and then the next year they say, I've got no other gains. Let's go ahead and do this now. They can sell that promissory note and then collect basically that big cash pile at that point. Go ahead.
Whenever I do seller financing, I always make sure to put in the contract that I get first right of refusal if they go to sell that note, because I want to be able to buy it first before they sell it to someone
Absolutely.
else.
How would you buy it though if you don't have the cash?
Well, I mean, there's different ways you can do it, but usually a couple years down the road, my capital's opened up again, and when they're saying, hey, I'm going to go sell this note, they usually sell it at a discount to cash it out, and then I say, well, can I get first shot at buying that note? So I put it in the contract so I know that I get first shot at it. Second, another reason why seller financing is so powerful is because they've used to being landlord for years, so they're used to the cash flow, and the thought of getting that check every month but not being the landlord anymore is very enticing to a lot of these people who are specifically tired landlords.
Yeah, absolutely. Absolutely. Did everybody catch what he was saying about putting in your contract when you do seller financing? Basically, getting a first right of refusal to buy that promissory note that they may then want to sell further down the road. That's a really good point.
Because they usually sell it at a discount because they need the cash now.
Sure.
And so the future value has more money, so I'll take that at a discount.
Yeah, and you don't even necessarily have to have that cash saved up. You could go borrow that money from somebody else.
Exactly.
Depending on how much they're willing to write a discount. You could use all of the methods we've talked about, 1 through 7, well maybe not all of them, but almost all of them to buy that note, right, and make money.
And a lot of times I can negotiate it. I'll give somebody like 20% equity instead of paying it back. They just
Sure.
get equity in the property.
Yep, sure. And then you don't need as much cash.
And now we all win.
Yep, exactly. Yeah, go ahead.
What do sellers typically do as far as like a term?
Oh wow. It varies quite a bit.
Yeah, it does.
It varies quite a bit. Yeah. Yeah. I'm not sure I would even try to give a generalization because I don't think I've ever seen them the same.
Don't put your head in the...
It's more about what they want.
Yeah,
Yes, more
it's
about
super
what they want.
flexible. Yeah, you can do whatever you want. You can do whatever people want to agree to.
Put yourself in the
I
head
guess
of
I
the
would
seller.
say it's what they want out of it, right?
Yeah.
It's usually establishing the terms.
Right. It goes back to their goals.
Yes.
Right? So whatever their goals are, if we can align our goals or align our interests, we're going to do that. And there's a lot of ways you can do that. But you have to understand what they want first.
Yeah, you have to have that conversation because you never put your head in the mind of the seller because you'll never guess what
Yeah,
they
you'll
want.
never know. You'll never know. Do you have another question?
No, I'm
Okay. Yeah, go ahead.
What are some of maybe your golden pickup lines as far as determining things that they're after?
In my experience, I haven't targeted seller financing. There's ways to target people who are likely to do seller financing who don't really know a ton about real estate, and that can be a really effective strategy. I've never done that. Every seller I've talked to who's willing to finance was really savvy, and so they all required 10%. They had prepayment penalties. They had all kinds of stuff. They knew what they were doing, and so I wasn't gonna get a great deal. That doesn't mean you can't, to be clear. It's just not what I've done. Yeah.
But also, if you want to sell the property and they don't really need the money right now, you can also just do 0% down, if you wanted to. There's different ways. So
you could carry it now.
And if there's people that want to sell on the market, cash deal's not going to work for them. You can still give it to them at their price instead of having all these price cuts. You can have it at their price, but then it's a win-win for them, but then you can have it. So it's okay, well, I want only to put 5% down and then maybe do a 10-year balloon and then refinance them out. And then they get more money long term.
That's right.
And then you get it down.
Yeah, so basically what she's saying is, let's say a property's been on the market for a while at $300,000, it's not selling, okay? So normally what a seller would do is they would lower the price, right, to the market clearing price. Let's say it's $250. You come to me and say, hey, I see that you want to sell this property. It's been on the market 90 days or more. You haven't really moved your price, but it seems like you need to sell. So what if we did this? What if I bought you at $300,000, but you financed the note at $300 or whatever? I'm not giving you any money, right, at closing, but you've got a promissory note, another asset. A promissory note is an asset. It's different than the real estate, but it is another asset in exchange, and it's the full value. But now you get control of the property and can add value to the property that that person wasn't willing to do, in whatever capacity that means. It can be a lot of different things.
And a lot of times too, you can play with the price. They might be selling for $300, so you say, well, I'll give you $350 if you let me go no money
Totally.
down.
Yep, totally.
And so that's another way to sneak in without
Totally.
having that bring any money, is just offer them more in the back end and then change the terms so it still cash flows.
Absolutely.
And then they're happy because they got more money out of you.
Yeah, absolutely. I would say unless you have a plan to add value to that property, I wouldn't do that, because now you're super underwater.
Yep.
And if the seller's any savvy, they wouldn't do that either, because you could walk from the deal and they would lose their value if they did that. Number 9, last one I'm going to talk about because it's probably most relevant for this market, is subject to. Who's heard of subject to? Okay.
It's your favorite.
I have a lot of thoughts about subject to, but I'm going to explain what it is first. So subject to is where you buy somebody's property subject to taking over their existing loan. So instead of you going out and borrowing money to buy the property at the purchase price, you say, hey seller, we'll give you this purchase price, I'm going to give you some cash, right, to buy the property, and then instead of telling your lender and telling title and all of that, you're going to give me the deed to your property. So basically I'm going to get the title, but we're going to keep the loan and I'm just going to start making your mortgage payments on your behalf, right? So whoever your lender is, Mr. Cooper, whatever, you're going to give me your login, whatever, I'm going to pay Mr. Cooper for you. So the loan keeps getting paid, the lender doesn't know anything, but now I have your title. And you can move on and do whatever you need to do. You can sell your house. You don't have to go through the whole process of a normal sale. Maybe you were underwater. Maybe you had to do what's called a short sale. Maybe you were going to walk away and you had to pay cash at closing. Whatever. They get to walk away and they don't lose any money. So it can benefit everybody, right? The seller of the property can benefit because they get a little bit of cash. They can walk away from the property. They don't have to deal with anything. They still have the loan, but they don't own the property. Okay? They have the loan, but they don't own the property anymore. So there's a lot of things that are tied to this. As the investor, this is a sweet deal. Typically, if you can put as little cash down as possible, this deal is amazing. This is a great way to build a very large portfolio when there's a lot of short sales or foreclosures going on. Yeah, go ahead.
Is that the same as assumption, I'm assuming?
What's that?
Same as assumption?
Yeah, basically. Well, it's not quite the same, actually, I should clarify. So what he's asking, is this the same thing as assuming a loan? And the answer to that question is no, because assumption means you qualify for the loan, and the lender knows you're taking it over. Typically, when you're doing an assumption, very few loans qualify, VA loans being the main example. Sometimes commercial loans will, sometimes you can get conventional loans to assume sometimes, but it's very difficult. It's at least a 60-day close if you're going to do that. So just keep that in mind if you're doing an assumption. It can be worthwhile because if somebody has a 2.5% loan, well, hell yeah, I want that, and you don't have enough cash to do a subject to, then you could try, but then you still have to come up with the difference for that seller, right, if they want cash at closing. So subject to is great for the investor. You're not doing anything illegal, okay? The seller of the property is doing something illegal, okay? The seller of the property is transferring the title of their property to another individual without notifying their lender. That defies the terms of their loan agreement. So they're breaking a contract. You gotta understand that. That's what you're telling the seller to do. So depending on how you feel about that, I have lots of feelings about that, but that is what's happening. They're transferring the title of the property to you without notifying the lender. Go ahead.
Is it ever legal or?
Basically never legal for the seller. For the seller. For the seller. It's perfectly legal for the buyer.
But I guess.
What about an
who you're
executive?
targeting is all.
What's that?
But who you might be targeting for like.
Who you're trying to help. Now, okay, so here's like the little like ethical ring around that people do. They say, well, I'm still helping them out of a bad spot, right? Like I'm giving them cash, they're able to walk away from their property, they're actually getting a pretty good deal out of it after all. And I'm an honorable person, I'm gonna pay their mortgage, like I have no intention of not doing that, yada yada. That's probably true and that's totally fine. You can do that. I know lots of people who do subject to. It's totally, like there's no judgment. I'm just saying that you are asking somebody to commit loan fraud.
What if it gets found out?
So this can happen, but it's very rare. Actually, I've never heard of it happening. But you can have what's called the acceleration clause or due on sale clause. Technically, there was a sale because there's a transfer of title. The lender can say, hey, you owe me 100% of that money, you got to pay me in 30 days or less. I've never heard of it
But
happening.
it would be you or the lender?
It would be so the loan is still secured against the asset. So here's the thing that's really funky. The loan is still secured against the asset, and so they can still foreclose and take the house, even though the person they lent the money to doesn't have the title anymore. They can still take the house.
So is that like the same idea as transferring the house to an LLC without notifying?
It's not exactly the same. That can happen. So what he's asking is, if I transfer the title, let's say I get a loan in my personal name, and I transfer the title of that loan to an LLC that I've created, will this happen? The acceleration, because technically I sold it, I filed a quick claim deed from myself to this LLC. Can I have this acceleration clause due? Yes, you can, but it almost never happens. Again, I've never heard of it actually happening. And I've done that. Because that's not quite the same thing, I think. Go ahead.
What about when you go to sell the house? Because that person's name is still on the loan, but you own it, you have the deed. So how does that work when you go, if you want to sell?
Great question. Yeah, when you go to sell, the loan has to be paid off. Remember, going back to our capital stack, this is why I started with this. It's super relevant. Go back to the capital stack. Who's in first position? The lender. Who gets paid first? The lender. Okay? Doesn't matter who has the title. They've got a secured instrument, a mortgage, against that property. Anybody tries to sell that property, they're getting paid. Okay? Doesn't matter who it is.
I guess my question about that is, if the person who, like, what if you're not in contact with the
Sure.
person who
No, I understand your
got
question.
the loan from? Don't they have to sign documents when to get
Not
that?
necessarily, because they don't have title. Right? So you have the title holder, you have control over the property, you get to determine when you sell the property, you get to determine what you sell the property for. You get to determine what you rent the property for. You own the property, you have the title. Okay? The other person just has the loan. But the loan is secured against the property, so that's why it's this like incestuous thing. So what ends up happening is you pay back the loan, and then you, the holder of the title, get paid all of the equity. The person who holds the loan does not get any equity, because they don't own the property. They only have the loan. But the loan is secured against the property. Does that all make sense?
Yeah.
I know it's super funky, but does that answer your question?
Yeah, I was just wondering if they had to sign any, like, they
Nope.
needed to be notified
Nope.
that you sold, and they're
Nope.
like, hey, what happened?
They don't necessarily need to sign anything. Sometimes the lender will send them stuff to sign, but technically no. They don't need to.
They'll get notice that the mortgage is paid off.
Yeah. So something else that can happen in this instance is you stop making the mortgage payment. Let's say I get the title, somebody else has got the loan, and I decide, screw you, I'm not going to pay your mortgage. I'm just going to collect the rent. Give me the rent, I'm not paying the mortgage. And I do that for as long as possible until it takes the lender to foreclose on me. Part of the reason subject to gets a bad rap is because lots of people did this. Okay? They would get the title of the property, they would get a renter in there, they'd collect the rent, they wouldn't pay the mortgage, and then who gets the record of an unpaid mortgage? That's right. The person who doesn't even control the property anymore, who you told I was going to pay your mortgage, you're not paying them, shows up on their credit, not yours. But I collected all that rent. Go ahead.
If you call the loan, is there anything you can do in order to kind of...
Yes.
Yeah, pay it off.
No, there's
You can
other
pay it
things.
off, you can assume it, there's all kinds of things you can do. So like, if the lender finds out that this happens, they can say, hey, we didn't qualify you, you can't pay this loan. You'd be like, no, actually I can. I want that loan, give it to me. And then you go through the underwriting process, basically.
Can I add, there's other
Yeah, go
things
ahead.
you can do too. A lot of times if you call the bank and just talk to them, they're happy that the note is being paid. So you kind of explain the situation and
Sure.
go that route first. There's also things like land trust deeds and other contracts that you can use to take over that property and it will work with the bank. So there are other negotiation skills that you have.
Absolutely. It's very rare that you're actually going to have to be, it's very rare that you're actually going to have a forced sale
Yes.
of the property. That almost never happens. Actually, I've never heard of it happen.
I've heard of it happening once.
Yeah.
Oh, there you go, one time.
Yeah.
Out of how many times
There's
have you
also,
heard
Yeah,
of it?
exactly.
there's also 2 ways to secure the seller too. You can do what's called a performance deed. It says the minute you miss a payment, the property goes back to them free and clear, no going to court, and all the money they've received so far they keep. That's one. And then 2, you use a loan servicing company, so they always make sure that that loan gets paid every single month.
It's
Sure.
establishing.
Yeah, it's like
credit
you
and
have
good
accountability,
policies.
basically.
Yeah.
Yeah.
Yeah. Okay, sorry, that was all I had. Here's our agents, Jordan, Tanner, and Ryan. You probably have seen them around.
Oh, look at those guys.
Yeah. Who said that? No, just kidding. And then there's Luke, Michael, myself. We founded Renjoy, etc. This is really important. I want to end with this. Anybody know who said this?
You?
No. Yes. Who said Warren Buffett? Nice job. Good job.
Thank you.
Yeah. This is super important. When you go out and talk to your friends and your family about getting a hard money loan and going down to this guy and getting a bridge loan, mezzanine debt, you start using these things, you're like, yeah, I'm going to buy property with no cash. Everybody's like, you're crazy, that's stupid and really risky. Here's the thing that's risky. It's not knowing what you're doing. Okay? You can borrow a lot of money at high leverage, and if you know what you're doing, it's not risky. Risk comes from not knowing what you are doing. Okay? So be very careful about assuming that you know what you're doing. Okay? But you can borrow a lot of money, high leverage, not use any of your own cash, and do very well. Consistently over a long period of time. It's very doable. Cool. Any other questions? Sweet. Thanks guys for coming. Really appreciate it. Yeah, hang out, enjoy your drinks. Come back in a couple of weeks. Oh, what's that?